Hey guys, I'm starting to get back in the market, and obviously the market is taking a beating as it is readjusting to the new realization that coming into next year we are going to have first it's a midterm election, and is anytime there's election and there's it's going to be very interesting, and it's going to be a challenging year next year because you have a backdrop of election year, and then you also have issues with inflation. And I mean, let's be honest here, the inflation that's here is really more to do with the shortfall of the United States not shoring up their supply chain on global trade. And I'm talking about the maritime shipping industry. What's happening in Long Beach and Los Angeles is a disgrace, and it was just a matter of time. And COVID did bring about this big surge in consumer goods demand, so we shifted from a service industry to a consumer goods industry. However, it's a tell that if you look at the U.S. GDP, and if U.S. GDP were to rise over 3% annually, the global supply chain, mainly the maritime shipping industry, was not set up to sustain. And now we are entering a new phase where the global shipping industry is pretty much controlled by foreign national companies, and from Hapag-Lloyd to Maersk to Costco, there are like 8 or 9 companies that control all the shipping industry. And even though the rates may come down from these elevated levels, I'm talking about the shipping rates, they are still going to be sustaining at high levels. Prior to COVID, just as an example, it took 30 cents for cost of shipping to ship, let's say, a toy Lego box. Okay, that's 1 foot, 12 inches by 3 inches deep, 12 inches by 12 inches by 3 inches deep. It takes 30 cents to ship that across from China, and now the cost has gone up to like 250 to 275, tenfold. And it may come down, but bottom line is that stuff is the main root cause of inflation. And the second part of inflation is the rental market, and rents are going up because we have underbuilt homes, and I'm very bullish on housing. Let's talk about where I see a huge opportunity in the next year, and that's Comstock Resources. Okay, so Comstock Resources is a natural gas company, and natural gas has risen to almost 6. It has come back to $4 per MBTU, and the reason why natural gas most likely will sustain above $3 a MBTU for the entire 2022 calendar year is because of the demand from overseas, mostly from Europe and China, and also from south of the border, Mexico. And also, since we have curtailed oil drilling permits, the associated natural gas is just not there in terms of the supply of natural gas, right? And unfortunately or fortunately, the fourth quarter of 2021 has been a seasonally warm quarter, and therefore the number of cold days has been less, and hence natural gas prices have come back down to like a 360 to 380 level. And I think this is a time to start buying Comstock Resources. Now, if we get a cold quarter 1 2022, and natural gas comes out like towards the end of March, and an average price of, let's say, $3.80 to $4, Comstock Resources can see 50% to 100% pop in prices. Okay, and let's go through the numbers here real quick. Okay, the company has a book value of 281, if you want to believe these numbers, and it has a revenue of 1.47, and it has a debt that's 2 times revenue. So all these energy stocks are highly leveraged, but unlike in the past, they have curtailed their capex, and the reason why I like this company is because, let me go through the spreadsheet here. Okay, if you look at this is 2021, okay, and this is basically the oil and gas sales, production. These are the expenses, which is the production taxes, gathering and transportation, lease, exploration, general admin, blah blah blah, and this is the operating earnings. But what you want to really look at this company is their cash flow, okay? Because here's the issue, okay? The general accounting rules require companies like Comstock to report their hedges in their earnings. For example, a lot of these companies, they will sell forward a lot of their production to cover their expenses. Okay, so for example, Comstock will sell 30 or 40 or 50% of their production for 2022 at locked in prices. Let's say they sell it at $3. Now, if it just so happens that natural gas averages $4, well, they had a loss of $1, 4 minus 3, and that would show up as a loss. Even though it's a paper loss, it would show up as a loss. So when you see these big negative losses, these are really because they had hedged their natural gas for 2021 at a low value, and then natural gas prices rose and they had to take it a loss. Okay, but you really want to look at their free cash flow per share. Okay, so in 2021 they are going to exit with a free cash flow per share of $3.62. So this company is trading at $8, and they already generated 45% of their value in free cash flow for 2021. Now let's look ahead in 2022. Okay, in 2022, the price that's being used here is $3.65. Now for 2022, they have already hedged 50% of their natural gas at $3.31. Okay, so assuming the remaining 50% they sell at a higher price, so when you average it out, it's $3.65. They're going to generate $4.80 in free cash flow. So if you take the average of this year and next year's, so 4 plus 3, 5 plus 8, so $4, right? And if you go $4 times 5, their target should be $20. It's five times their free cash flow. Now let's just, for argument's sake, you know what? Natural gas would probably average $3. Okay, so since they are at 331 and 3, let's say on the low side, it's going to be 315. Okay, well, if you go at 315, they still will. The target is $17. All right, and now if you say the average at 331, since half of the gas is already sold at 331, is $18. Okay, the worst case scenario is, let's say half of the gas is already hedged at 331. Let's assume that the other half is sold at $2. Okay, so $2 so 2 and 331, you're talking about 5, so 275. Okay, approximately. My math is probably bad, so let's just do this. $16. Okay, so even if natural gas were to tank to $2.50, they're still double. They're still freaking double if you go 5 times free cash flow, right? Okay, and if you look at the trend in this country, the current administration is gung ho on global warming. They got the wrong approach. People are buying $50,000-$60,000 Teslas thinking they're solving global warming. How fucking stupid is that, right? You want to solve global warming, you plant more trees, right? And no question, right, that the car is a great car, and you should buy it for that. And most likely what's going to happen is, as oil prices will go up, people will be forced to buy electric cars because the gasoline car, the maintenance plus, I'm expecting gas to be $6 a gallon this coming summer, will force more people to seek electric cars. Okay, so it's like your hand is being forced. And coming back to this thing, I personally feel if we have a cold winter, natural gas most likely will average about 375 for the entire year, and in the following 3 or 4 years, I think natural gas should sustain between 375 and $5. Okay, I there's no way it's going to come down. Okay, so let's just assume 375 and it's $20. Okay, so Comstock is selling at $8 today, and I would say start accumulating this thing, and if it goes lower in the next 2-3 weeks, because these are the next couple of weeks is still relatively warm, and natural gas prices may go sideways or trend lower, and this is the time to start accumulating, because I see a 50% profit on Comstock Resources.